Well, I would say that despite keeping the rates unchanged, RBI in fact has done a lot more, especially in terms of soothing the nervous bond market sentiments. In fact, that has led to the yield or the benchmark 10-year yields easing to a 5-week low, and on an intraday basis, the yield did hit nearly around 5.93%. In fact, if you look at the overall announcements by the RBI, well, all the market participants and experts has stated that quite a few of the announcements are really positive. In fact, if you firstly let's look at the backdrop under which these announcements are coming. 18 poll was expecting RBI to keep rates unchanged with an accommodative stance, but we were also expecting that RBI would release the GDP as well as inflation expectations, and bond market sentiments were really nervous given the fact that how would RBI really go ahead and absorb such high borrowing, and therein RBI has done a lot more according to several experts. Let's look at the policy now. Well, RBI of course did keep the rates unchanged. However, RBI has stated that they would maintain accommodative stance for as long as it is necessary. In fact, herein I would quote the governor. He stated that decided to continue with the accommodative stance of monetary policy as long as necessary, at least during the current financial period and into the next year, in order to revive growth on a durable basis and mitigate the impact of COVID-19, while ensuring that inflation remains within the target going forward. In fact, this really was an important statement. This does give a good amount of room to RBI to cut rates depending upon the growth inflation dynamics. Various economists still expect under 25 to 50 bips rate cuts coming into the rest of the fiscal FY21, especially from December, or especially in the December policy, or maybe even in the February policy. Besides the stance, RBI did mention that although growth is seen coming back in the positive zone, in Q4, RBI sees GDP growth for FY21 to contract 9.5%. With risk tilted to the downside. RBI also did give some good commentary in terms of the overall growth. They did state that growth may break out of the contraction and turn positive by Q4. COVID is a silver lining. There's a silver lining visible in flattening of active cases load curve in India. Modest recovery is seen in the high frequency indicators, which is likely to strengthen in H2. We should be watching out for that. Agriculture activity, or rather outlook on agriculture, is definitely bright, and that manufacturing firms expect capacity utilization to recover in Q3 2020. In Q3 of FY21. They also mentioned that private investments and exports are likely to be subdued. External demand is still anemic. However, the current momentum of upturn gains ground. A faster and stronger rebound is eminently feasible. So yes, we should be watching out for that. On the inflation front, well, RBI's commentary was very apt, I would say. This is what even the experts do state. RBI did state that current inflation bump is transient. Projection indicates that CPI is likely to ease towards the target by Q4 of 2021. And the recent rise in inflation is more on account of the supply-led disruption. So clearly RBI is willing to look beyond the recent challenges on the inflation front. On the bond market side, RBI did have a lot to say. In fact, RBI has stated that they remain committed to complete the borrowings of both the center as well as the state in a non-disruptive manner. RBI also stated that they would be conducting OMOs in state development loans as a special case during FY21. They also announced on-tap TLTROs up to rupees 1 lakh crore for a tenor of 3 years for certain specific sectors. We are yet to see which are those specific sectors, and they also stated that RBI stands ready to conduct market operations as required via variety instruments, and they hiked the size of OMOs to 20,000 crore. All these measures by the RBI are definitely welcome from the bond market participants. In fact, Lakshmi Iyer from Kotak AMC stated that To this effect, the OMOs amounts have also been increased by rupees 20,000 crore. On tap TLTROs for bonds is a great liquidity booster and would be good for corporate bond segment. OMOs in SDLs, which is state development loans, is a fantastic move and can help bring down spreads versus the central government bonds. RBI's willingness to look beyond through the current phase of high inflation should work as a strong anchor for the bond yields. In fact, this was a very important statement coming in from Lakshmi Iyer as well. Upasana Bharadwaj from Kotak also mentioned that overall the comfort from RBI on easy liquidity, OMOs and prolonged accommodative stance will provide a major relief to the markets. Besides this, of course, RBI also has gone ahead and given certain relaxations to the HFCs. Risk weights are now linked only to LTV, which is loan to value, for individual housing loans. A risk weights of 35% where LTV is up to 80% and risk weight of 50% where LTV is over 80 to 90%. What this would do is this will reduce the capital requirement by the HFCs and it would help them bring down their lending rates for the entire sector. It will also be, of course, beneficial for the individual borrowers. As a result, we did see a good amount of HFCs going up in trade. So all in all, I guess a lot more has been done by the RBI even by keeping rates unchanged.